risk management is widely misunderstood in trading, often reduced to a mechanical guideline applied merely to protect capital, but in reality, functions as a psychological safety system that maintains mental balance under uncertainty. While traders may focus on stop losses, position sizing, and account limits, the real impact of ignoring risk manifests first in the mind rather than in the account balance. When risk is unmanaged or underestimated, stress levels rise steadily, and the brain remains in a heightened state of alert, constantly anticipating loss or seeking relief. Persistent uncertainty causes the nervous system to enter a continuous loop of anxiety, where each tick of the price chart, each candle formation, and each minor fluctuation becomes a potential threat, eroding composure and clarity. Decisions that might otherwise be deliberate and analytical begin to shift toward impulsive reactions. As fear and hope alternately dominate cognitive processing, traders' attention narrows, tunnel vision sets in, reducing the ability to objectively interpret market structure or probability-based signals. Small losses, under disciplined risk control, would be inconsequential, start to feel magnified. The mind associates trading activity with tension, and even opportunities that fit a well-tested strategy provoke hesitation. Over time, this pattern compounds, creating a feedback loop in which emotional reactivity diminishes both execution quality and the confidence needed to follow established rules. Unmanaged risk activates primitive survival instincts. Fear, triggered by the prospect of loss, suppresses logical analysis, while hope, driven by a desire to recover or make back unrealized losses, overrides planning and encourages impulsive entries. The market, rather than being seen as a probabilistic environment where risk and reward coexist, transforms into a source of threat. Price movements that would normally be interpreted as data points to guide disciplined action instead become catalysts for emotional responses, a stimulus for anxiety, excitement, or panic. These emotional reactions further impair decision-making, causing hesitation on entries, premature exits on potential winners, and an overall loss of strategic alignment. The first cracks in confidence appear subtly, often unnoticed at first. Uncontrolled trade, each exposure beyond the trader's comfort zone, slightly erodes trust in execution. When a stop loss is breached, not only capital that is affected, the trader experiences a psychological loss, internalizing the outcome as a reflection of personal judgment rather than as an expected element of probability. Internalization gradually shifts the association between trading and opportunity into a connection between trading and stress. A sequence of small but unmanaged losses compounds this effect. The mind begins to anticipate failure, expecting that the next trade will produce more anxiety, rather than focusing on the execution of rules. This anticipatory stress reduces clarity, slows reaction times, and increases the likelihood of errors. Emotional fatigue accumulates quietly, often without immediate awareness. Over time, trader may find that decisions which once felt straightforward now require excessive mental energy, that strategies once executed with confidence now trigger doubt, and that patience, once a hallmark of disciplined behavior, has diminished. The trader becomes reactive rather than proactive, reacting to price movements emotionally instead of acting according to tested methodology. Subconsciously, the mind starts to view trading as a series of hazards rather than a series of calculated decisions. Risk management, when ignored, produces an invisible psychological toll long before financial ruin appears. The erosion of confidence is gradual, subtle, and cumulative. Unlike an account drawdown, measurable and observable, the damage in the mind is harder to detect but equally destructive. Over time, hesitation grows, impulsivity increases, and mental resilience diminishes. Even when a trade aligns perfectly with strategy, the lingering anxiety from previous uncontrolled risk can prevent full commitment to execution. Emotional interference distorts perception, making outcomes seem more extreme than they are. Small profits may feel like relief, while small losses feel catastrophic. The mind's expectation of pain reinforces itself, creating a self-fulfilling cycle that intensifies stress and undermines performance. Internal erosion can be more devastating than any single monetary loss, because it undermines the trader's ability to consistently apply rules over time, is the true source of sustainable profitability. The psychological cost of unmanaged risk also manifests in heightened sensitivity to external stimuli. Market noise, conflicting opinions, social media commentary, and anecdotal advice gain disproportionate influence when internal stability is compromised. Trader seeks reassurance or distraction to relieve mental pressure, which often leads to reactive decisions and a further decline in discipline. Mental exhaustion sets in, reducing working memory capacity and the ability to process complex information. This impairs judgment, increases susceptibility to cognitive biases, and magnifies emotional responses. Stress hormones interfere with rational thinking, making probability and statistical edge secondary to the immediate desire to avoid discomfort or regret. Once the association between trading and anxiety is established, self-reinforcing. Each uncontrolled trade confirms the expectation of tension, each loss reinforces anticipation of future stress, and the mind becomes hyper, aware of potential threats rather than opportunities. Confidence diminishes not because the market is inherently difficult, but because the trader's ability to engage with it rationally has been compromised. Over time, performance deterioration may become noticeable in slowed decision-making opportunities, overtrading in attempts to regain losses, or undertrading due to fear of new losses. Emotional dysregulation spreads to other aspects of trading psychology, including discipline, patience, and risk assessment, compounding the initial mental damage caused by ignored risk. In essence, risk management is not merely a set of rules for protecting capital. It is a foundational framework for preserving mental integrity. Without it, trading transforms from a structured exercise in probability and preparation into a minefield of psychological triggers. Ignoring risk does not only threaten account balance, it initiates a cascade of cognitive and emotional challenges that erode focus, decision-making quality, and long-term confidence. Traders who fail to implement and respect risk management expose themselves to this invisible damage, often without recognizing its presence until performance has already declined. Protecting capital is important, but safeguarding the mind is essential. The consequences of neglecting risk extend beyond numbers. They manifest in stress, hesitation, emotional reactivity, and ultimately, in the gradual collapse of execution quality. The first and most critical damage occurs internally in the cognitive and emotional systems that govern trading behavior. By the time financial losses accumulate, the psychological harm has already set the stage, reducing resilience, increasing fear responses, and making recovery more difficult. Understanding risk management as a psychological safeguard, rather than simply a financial rule, is therefore essential for long-term survival in trading. It is not just about limiting exposure to price movement, but about creating mental conditions where rational, disciplined, and confident decision-making can thrive. Unmanaged risk triggers a chain reaction in which stress, fear, hope, impulsivity, and eroded confidence undermine the ability to act according to plan. Every trade taken without clearly defined risk increases mental pressure, and every uncontrolled outcome chips away at internal trust. The cumulative effect is a mind constantly in tension, interpreting probabilistic market outcomes as personal threats rather than neutral events. Is the invisible damage behind unmanaged risk, a psychological erosion that begins well before any financial collapse and ultimately dictates whether the trader can survive, learn, and grow in the markets. Risk management, therefore, must be treated not only as a tool to protect capital, but as a system to protect the mind, preserve decision-making integrity, and sustain long-term confidence, ensuring that the trader remains capable of acting rationally and consistently regardless of market volatility, uncertainty, or outcome. When risk is oversized relative to a trader's capacity, the mind experiences a magnified emotional response to every market fluctuation. Amplification profoundly undermines consistency, discipline, and long-term performance. Small price movements that would normally be interpreted as routine volatility suddenly feel catastrophic, and ordinary drawdowns begin to appear unbearable, creating a psychological environment in which calm, rational analysis is nearly impossible. Emotional stability, often overlooked in trading discussions, the foundation upon which clear thinking, consistent execution, and structured decision-making are built. Without it, even the most robust trading plans begin to erode under pressure. Rules that were once adhered to without question are broken impulsively. Stops are moved, parameters are ignored, and positions are adjusted reactively, with justification arising from immediate feelings rather than logical reasoning. The result is a decision-making process hijacked by emotional extremes in which fear and hope dominate the cognitive landscape. Fear, triggered by the mere prospect of loss, forces premature exits from positions that otherwise fit strategy and probability, turning potentially profitable trades into avoidable mistakes. Conversely, hope, an equally insidious emotion, causes traders to hold losing positions longer than is prudent, expecting recovery or reversal that may never materialize. Both fear-driven and hope-driven behavior are destructive, as they erode objectivity, undermine strategic alignment, and systematically damage overall performance. When risk is unmanaged, objectivity vanishes. Charts cease to function as analytical tools and instead become emotional triggers. candlestick patterns, trend lines, support and resistance levels, and other technical indicators are no longer processed for their probabilistic significance. Instead, each movement evokes an immediate reaction. Price spikes provoke panic, minor pullbacks spark anxiety, and the natural ebb and flow of the market feels like a constant series of threats and opportunities that must be responded to instantly. Environment creates a feedback loop in which one emotionally driven decision leads to another, compounding risk and magnifying psychological strain. A loss often triggers revenge trading, where the mind seeks to recover lost ground through larger or more frequent trades, abandoning prior rules or risk controls. Likewise, win can foster overconfidence, leading to oversized positions, premature scaling, or reckless experimentation. This cycle reinforces itself, normalizing destructive habits and subtly rewiring the trader's behavior to favor emotional reactions over disciplined execution. Over time, impulsive actions begin to feel familiar, while discipline and patience start to feel uncomfortable or unnatural. The trader becomes increasingly reliant on the adrenaline and tension generated by emotional extremes, mistaking activity for skill and reaction for insight. Mental fatigue accumulates as the brain is forced to manage constant high-intensity emotional signals. Cortisol and other stress hormones impair focus, reduce working memory, and heighten susceptibility to cognitive biases, further distorting judgment and amplifying the effects of previous errors. With each successive emotionally driven decision, confidence erodes. What was once a structured approach to probability and edge becomes a series of reactive, emotionally charged trades. Decision-making is no longer guided by analysis, testing, or systematic methodology, but by fluctuating internal states of fear and hope. Creates a destructive spiral in which losses confirm fear, fear provokes overreaction, and overreaction produces further losses, reinforcing the cycle. Emotional volatility does not only affect individual trades, it undermines the trader's perception of the market as a whole. Patterns that were previously recognizable become obscured by reactionary impulses. What might have been interpreted as normal consolidation or retracement is seen as a signal to act. Context and perspective are lost, replaced by immediacy and urgency. Mental state erodes trust in one's own strategy, as the repeated emotional swings make it difficult to separate skill from chance, discipline from panic, rational decision-making from impulsivity. The normalization of this feedback loop has long-term consequences. Impulsive behavior feels familiar, whereas adherence to rules begins to feel uncomfortable or restrictive. Inversion of natural preference is dangerous because it causes the trader to actively avoid disciplined, calculated action, favoring emotional responses that provide short-term relief or excitement at the expense of long-term survival. External influences such as social media commentary, forums, and peer opinions further exacerbate this instability, as the emotionally reactive mind is particularly sensitive to validation, judgment, and comparison. Noise and conflicting perspectives become disproportionately persuasive, leading to even greater deviation from personal rules and strategy. Recovery from this state is difficult because the psychological patterns are self-reinforcing. Each emotionally driven decision strengthens neural pathways associated with fear and reactivity, making rational behavior more effortful and less automatic. The trader may attempt to correct behavior without structural risk management and emotional safeguards. Relapse into reactionary behavior is likely. In essence, averse risk creates not only financial exposure, but also a profound psychological vulnerability. Emotional extremes destabilize judgment, impair focus, distort perception, systematically degrade decision-making quality. The destructive feedback loop that emerges is invisible to external observers, but deeply damaging internally, slowly transforming disciplined traders into reactionary participants, whose performance oscillates between panic, induced losses and hope-driven overcommitments. Understanding this dynamic is critical because the consequences of unmanaged risk extend far beyond the numerical impact on the trading account. The mind itself becomes the primary locus of danger, with fear, hope, and emotional instability directly undermining the capacity for consistent execution. Recognizing that risk management is not merely a financial safeguard, but a psychological stabilizer is essential for maintaining clarity, objectivity, and resilience in trading. By controlling risk, the trader creates an environment in which emotions remain proportional to actual exposure rather than amplified by fear or hope, ensuring that decisions can be made rationally, rules can be followed reliably, and performance can be evaluated objectively. Ignoring this principle traps traders inside a cycle of emotional distortion, where each reaction further compromises the mind's ability to engage with markets in a disciplined manner. Long Term success in trading depends not only on analytical skill or strategy design, but also on the management of psychological responses to risk. Emotional volatility caused by oversized positions or unmanaged exposure undermines the execution of even the most carefully constructed strategies. The feedback loop of bad decisions reinforces itself over time, making discipline feel uncomfortable and impulsive behavior feel natural. Stabilizing emotions through proper risk management is therefore not optional, it is a prerequisite for consistent performance, clear thinking, and sustained confidence. Traders who fail to implement this safeguard expose themselves to prolonged periods of stress, reduced cognitive capacity, and a normalization of destructive behavior patterns, all of which erode their ability to survive and thrive in the markets. The critical takeaway is that ignoring risk management destabilizes emotions, distorts judgment, traps decision making within a destructive feedback loop, ultimately making consistent profitability unattainable. Emotional stability, enforced by proper sizing, stops, structured exposure, allows rational decision making to dominate over fear and hope, preserves objectivity in chart interpretation, and prevents the normalization of impulsive behavior. Managing risk effectively is therefore both a protective measure for capital and an essential strategy for preserving the integrity of the trader's mind, ensuring that discipline, clarity, and consistent execution can be maintained even under market stress, volatility, or uncertainty. Without this foundation, trading becomes less a skill-based activity and more a psychological endurance test, where emotional reactions dictate outcomes, consistency disappears, and performance fluctuates in accordance with internal emotional extremes rather than strategic alignment. Proper risk management breaks the cycle, maintaining proportional emotional responses, enabling objective analysis, and preventing the feedback loop of bad decisions from taking hold, making it a central pillar of long-term trading survival and the cornerstone of emotional stability in the financial markets. Confidence in trading is not an abstract or innate trait. It is built progressively through repeated experiences where outcomes align with expectations, and the rules of engagement are respected. The foundation of this confidence rests heavily on predictability, which is largely governed by proper risk management. When risk is defined, the trader knows the maximum possible loss before entering a position, creating a framework within which the mind can operate without constant alarm. Each trade, whether it results in a gain or a controlled loss, reinforces a sense of stability because the outcome, even if negative, was anticipated and accounted for. Predictability fosters trust in strategy and execution. It allows the trader to distinguish between skill and chance, to measure performance objectively, and to maintain emotional equilibrium even when the market moves against them. Without clearly defined risk, this critical element of predictability disappears. Outcomes begin to feel random and uncontrollable. Losses no longer fit within a framework of probability, they appear as arbitrary punishments, undermining confidence at a structural level. Randomness introduces chaos into the mind, making it difficult to trust decisions, follow rules, or stay committed to strategy. When results cannot be anticipated, belief in one's own plan erodes and hesitation replaces decisiveness. Execution becomes reactive rather than proactive, each price movement evoking doubt and second-guessing. The mind, overwhelmed by unpredictability, begins to associate trading with anxiety instead of opportunity. The psychological weight is compounded by uncertainty itself. Every open position, every pending order, and every market fluctuation becomes a source of stress. Mental fatigue accumulates as the brain struggles to process multiple potential outcomes simultaneously. Sleep quality deteriorates, attention spans shrink, and focus on execution weakens. Even small decisions become mentally taxing because the absence of risk control magnifies the consequences of error. The trader experiences constant hypervigilance, anticipating losses that might not even occur, and reacting to potential threats as if they are certain. Relentless mental load further reduces performance, reinforcing a feedback loop of self-doubt and hesitation. The more the trader fears loss, the more reactive decisions become, and the more the results fail to meet expectations, the more confidence erodes. Over time, this cycle transforms trading from a structured, probabilistic activity into a psychologically punishing endeavor. One of the most damaging effects of unmanaged risk is its impact on personal identity. When losses are allowed to exceed planned limits, they cease to function as neutral data points in a probabilistic system, and instead become personal indictments of competence. The mind interprets each loss as a failure of character, skill, or intelligence rather than a normal variation inherent to market behavior. Trading shifts from being a process-oriented endeavor to a test of personal worth. Each mistake or unfavorable outcome is internalized, and the emotional consequences are magnified. Confidence, which is usually rooted in understanding, preparation, and execution, begins to fracture because the trader equates random market movements with personal inadequacy. This misalignment between performance and self-perception intensifies stress, creating further hesitation, indecision, and avoidance. The trader may begin to avoid trades that fit their edge, guess positions, or abandon plans prematurely out of fear. Over time, repeated exposure to uncontrolled risk corrodes psychological resilience. Small losses become magnified, large losses provoke panic, and even routine drawdowns can feel catastrophic. The mind starts to operate defensively, prioritizing avoidance over opportunity, and the ability to act with clarity and discipline deteriorates. As a result, the identity of the trader shifts from someone executing a probabilistic strategy to someone reacting to perceived threats, chasing emotional security rather than systematic edge. This identity damage feeds back into the cycle of confidence erosion. Every hesitation, impulsive adjustment, or emotional trade reinforces the belief that the trader cannot trust themselves or their methods. The emotional stakes of trading are amplified by the lack of structure, transforming routine market fluctuations into existential threats to competence. This makes recovery increasingly difficult, as the mind becomes conditioned to fear failure rather than interpret losses objectively. Over time, unmanaged risk produces a subtle yet profound dismantling of both confidence and psychological resilience. What begins as an oversight in sizing or stop placement escalates into chronic self-doubt, avoidance behavior, and an emotional reactivity that dominates decision-making. Normal trading losses, which would be expected and accounted for in a well-managed plan, become personal failures, shaping perception and undermining the trader's sense of agency. The mind, under constant strain, begins to conflate statistical variance with incompetence, eroding trust in both process and self. The ultimate cost of ignoring risk management is therefore not measured solely in financial terms, but in the slow decay of confidence and the distortion of identity. Traders who fail to maintain structured exposure experience a loss of predictability, a weight of constant uncertainty, and a personal association between trading outcomes and self-worth. This combination creates a toxic feedback loop in which hesitation, doubt, and emotional reactivity dominate behavior, replacing strategic clarity with fear-driven responses. Proper risk management functions as a stabilizing framework, protecting both capital and the psyche. It ensures that losses are predictable, contained, and psychologically manageable. When risk is controlled, confidence can develop in parallel with skill, as each decision is validated by alignment with a plan rather than the volatile whims of the market. Without it, the mind interprets randomness as failure, uncertainty as threat, and normal variation as proof of inadequacy. Confidence, gradually through predictable outcomes and disciplined execution, erodes when these foundations are absent. Identity is similarly damaged because trading is no longer seen as a probabilistic practice, but as a personal trial, where each result becomes an emotional verdict. Unmanaged risk thus transforms the trading environment from a structured system into a psychological battlefield, where losses are internalized, decisions are clouded by fear and hope, and confidence deteriorates under the pressure of unpredictability. Over time, erosion of confidence and identity can lead to chronic underperformance, avoidance of opportunity, and a fragile psychological state in which trading is perceived less as a skill and more as a series of emotionally charged survival tests. Core lesson is that confidence is inseparable from predictability, and predictability is inseparable from disciplined risk management. When the mind is deprived of structure and outcomes are left uncertain, the very foundation of belief in one's abilities collapses, leaving hesitation, self-doubt, and identity damage in its wake. Every open position becomes a test of personal courage rather than a calculated decision, and every loss reinforces the perception of inadequacy rather than the reality of probability. In this sense, risk management is not just a tool for capital preservation, it is the mechanism through which confidence is earned, identity is protected, and the trader's psychological resilience is maintained. Ignoring it converts ordinary market fluctuations into personal threats, random variance into judgment of self-worth, and predictable process into emotional chaos, gradually dismantling both the trader's confidence and their sense of competence. The mental consequences of this neglect are profound, lasting, and insidious, making the control of risk the most critical factor in maintaining both performance and psychological health in trading. By defining, containing, and respecting risk parameters, traders create an environment in which confidence can grow steadily, decisions can be executed without fear, and losses are absorbed as data rather than personal failures. Without such boundaries, confidence erodes, identity suffers, and psychological resilience is compromised, illustrating that risk management is the foundation upon which not only financial stability, but also the very structure of self, trust, and professional identity depends. Management is often misunderstood as a mere financial precaution, a set of mechanical rules meant only to protect capital, but its true power extends far beyond the monetary realm. It functions as psychological armor, creating boundaries that stabilize the mind in the face of uncertainty and market volatility. When risk is defined before a trade, the trader knows exactly what is at stake. Knowledge creates structure, which in turn restores mental stability. Instead of being caught in a cycle of fear and hope, where every price movement triggers emotional reactions, the mind can operate with clarity and composure. Risk provides a framework within which losses are not catastrophic, but expected, manageable, and contained. The brain is no longer under constant threat, waiting anxiously for the next adverse move. Stress levels decrease because the consequences of each decision are predictable, even when the market moves against the position. Predictability creates a sense of safety without removing the inherent uncertainty of trading, allowing the trader to function optimally. With these emotional boundaries in place, decision-making becomes calmer and more consistent. Plans are followed rather than abandoned, rules are respected rather than bent, and trades are executed based on structure rather than fear or impulse. The mind is freed from the reactive patterns that dominate when risk is ignored. Clarity begins to guide actions instead of emotion. Losses, when controlled, lose their emotional sting, no longer represent personal failure or evidence of incompetence. Instead, each loss becomes data, a component of probability that informs future decisions. Shift in perception transforms trading from a psychologically punishing activity into a learning process. Adjustments can be made logically, without panic, and lessons can be absorbed without the interference of fear or frustration. The emotional response to loss diminishes, leaving space for reflection, understanding, and growth. Psychological resilience of the trader is strengthened because each setback is framed not as a crisis, but as an opportunity to refine approach and sharpen judgment. True confidence is not built on winning streaks or the accumulation of successful trades alone. It is built on the understanding that no single outcome, no matter how adverse, irreparable harm. Risk management provides this assurance. When traders know that losses are contained and that their capital and mental state are protected, confidence grows steadily over time. It is no longer dependent on external validation, market sentiment, or the illusion of constant success. Confidence becomes internal, mechanical, and resilient because it is rooted in discipline and preparation. The disciplined application of risk rules creates a feedback loop where structure reinforces stability, stability reinforces clarity, and clarity reinforces confidence. Each decision, each trade is executed with a calm mind free from the emotional turbulence that plagues those who ignore risk. This form of confidence is sustainable, survives losing streaks, volatility spikes, and unexpected market shocks. It is not fragile, temporary, or borrowed from external agreement, earned and protected through adherence to structured risk principles. The benefits of risk management extend beyond emotional stability and confidence, protects attention, focus, and cognitive resources. When the mind is not overwhelmed by uncontrolled risk, it can observe the market objectively, identify opportunities, and respond to probability rather than panic. Execution quality improves because decisions are made from a place of understanding rather than reaction. Psychological advantage of defined risk is compounded over time. Traders develop patience, consistency, and mental resilience, far more valuable than short-term gains or popularity. In contrast, ignoring risk slowly dismantles these foundations. When trades are taken without boundaries, losses trigger disproportionate emotional responses. Fear, frustration, and self-doubt infiltrate decisions, impairing judgment and creating a cycle of reactive behavior. Uncontrolled loss chips away at confidence, distorts perception, and erodes the ability to execute a plan with discipline. Without psychological armor, even minor setbacks feel catastrophic, compounding stress and reducing the trader's effectiveness. The core message is that risk management protects far more than capital. Safeguards clarity, emotional stability, confidence, and longevity in the market. By creating defined parameters around exposure, it allows the mind to operate in a state of equilibrium where losses are contained, decisions are structured, and performance can be sustained over time. Ignoring this principle does not only threaten financial outcomes, it slowly destroys the psychological foundation required to survive and thrive. Traders who respect risk management enjoy a distinct advantage. They can act decisively without fear, learn from mistakes without panic, and maintain composure when markets test both patience and skill. This mental freedom is the most valuable asset a trader can cultivate. Management is therefore inseparable from long-term success. It is not a passive form of protection, but an active system of mental conditioning. It teaches discipline, reinforces consistency, and enables the trader to develop a mindset where confidence is independent of short-term results. Structured environment created by proper risk controls prevents emotional extremes from dictating behavior and ensures that every decision is grounded in probability, process, and preparation. By contrast, those who neglect risk expose themselves not only to larger financial losses, but also to emotional instability, cognitive fatigue, and a fragile sense of self-efficacy. In this context, risk management is the shield that separates rational, process-driven traders from those dominated by emotion, reactive impulses, and the unpredictability of uncontrolled exposure. Every aspect of psychological armor, from calm execution to protected confidence, enabled by defined risk. Losses become neutral, mental clarity is preserved, and decisions are executed with discipline. Over time, this system compounds, producing a trader who is resilient, patient, and confident, regardless of the immediate outcomes of individual trades. In short, management is the cornerstone of both financial and psychological survival. It provides the framework for consistent decision-making, ensures emotional equilibrium, and cultivates confidence that cannot be shaken by market volatility. Ignoring it slowly undermines every layer of stability, transforming trading from a structured, kill-based endeavor into a series of reactive, emotionally charged events. The long-term advantage belongs to those who treat risk as more than a number on a screen, protective system, a source of discipline, and the foundation upon which confidence, clarity, and longevity are built. Every trade executed within defined risk boundaries reinforces this structure, ensuring that the mind remains balanced. The process remains intact, the psychological armor remains unbroken. Through this lens, risk management is not merely about avoiding loss. It is about preserving the trader's ability to think clearly, decisively, and survive both the market and the psychological pressures that accompany it. By respecting this principle, traders create conditions where confidence grows steadily, learning occurs without fear, and longevity in the markets becomes achievable, illustrating that true mastery of trading begins not with strategy alone, but with the disciplined control of risk and the psychological protection it affords.